This is Chapter 6, Part B. We're going to move from standalone risk to risk in a portfolio context. First, we need to find the expected return of a portfolio. The formula, as you'll note, is very similar to the one for expected return on an asset. It's a weighted average of the expected returns of all the assets in the portfolio, with the weights equal to the percentage of dollars invested in each asset. As with the expected return on an asset, the weights must add up to 100%, or 1. According to the case, the investor has 100% of his portfolio in Blandy stock, but has become concerned after seeing how risky Blandy is. He wants to shift to 75% Blandy, 25% Gourmand, but wants to see what the return would have been for the last 10 years had he pursued this allocation. Here's our 10-year historical data again that we need to answer the investor's question. Before we go further, compare the returns in each year for Blandy and Gourmand. They move against each other. When Blandy is up, Gourmand is down, and vice versa. When we construct a portfolio of 75% Blandy, 25% Gourmand, we get a portfolio return that's a weighted average of the two stocks' returns. But the standard deviation of the portfolio is less than either of the individual stocks. Since you've already had a finance class, you probably know the answer. It's due to the counter-cyclical behavior of the returns on the two stocks seen on the previous slide. While not absolutely opposite to each other, Blandy and Gourmand move differently enough to provide diversification benefits. So how do we measure how much these two stocks move together? Using the correlation coefficient, designated by rho. Using historical data is tedious, as the slide notes. Basically, the formula is the covariance of Blandy and Gourmand divided by the product of the standard deviations of each stock. Given a correlation of 0.11, with one being perfectly correlated, moving absolutely together, these two stocks can be combined to reduce the overall risk of a two-stock portfolio. Covariance actually measures how much the returns on two assets move together. But covariance is unbounded, meaning the resulting number can be anything, minus 25 plus 115. The plus or minus tell you something, but not enough. The correlation coefficient scales covariance to a range of -1 plus 1, with -1 perfectly negatively correlated, plus 1 perfectly correlated. We've looked at a two-stock portfolio, but most investors know that a well-diversified portfolio requires more than two assets. Assuming stocks in general are not perfectly correlated, adding more stocks will reduce the risk of the portfolio at a declining rate. A graph similar to this is probably in just about every corporate finance textbook to illustrate the result of adding stocks to a portfolio. Note that market risk, the risk of being in the market as opposed to investing in the risk-free asset, cannot be eliminated. But adding more stocks can reduce the company-specific risk, with the benefit more or less maxing out at about 40 stocks. The chart on the previous slide also illustrates another concept of risk. Standalone risk is composed of market risk and diversifiable or company-specific risk. Firm-specific or industry-specific risk can be diversified away. Market risk cannot. The conclusions are fairly obvious from what we've seen in the numbers and graphs. The point: rational investors need to hold a well-diversified portfolio in order to minimize firm-specific risk. An investor cannot hold a single asset in isolation and expect to be compensated for the total risk of that asset. This ends Chapter 6, Part B. In Part C, we'll move on to the capital asset pricing model, CAPM, and the security market line, SML.